Welcome to the All Financial Hour podcast with Steve Aul.
I tell you what is also making headlines here, Steve, is warnings about a significant stock market pullback. Ray Dalio is the CEO of the hedge fund Bridgewater, which manages about $90 billion. He quoted an ancient Chinese proverb that says, a smart rabbit has three holes, basically saying when trouble strikes, you need to have some options. So do you create, your retirement plans with an exit ramp or maybe an exit strategy from the market? And how would you describe that?
Well, there's a couple different ways that you can do it. I love that. I'll use it on a lot of occasions. It wasn't raining when Noah built the ark. So I think we have to look at those types of things. And, a smart rabbit has three holes. You got to have ways to get around it. And that's where I look at it. I think it's very, very important. And there's two different ways to protect assets that are market assets. One, through the investment philosophies. We look at it to say static. Static basically says that we're going to stay the course unless there's just a major turn, and we're going to adjust once a year for what I call drift. It's like if I have an 80-20 portfolio, the markets are way up. Now I might have a 90-10. Let's adjust it back to where it was at. So that's a static portfolio. Tactical portfolios. Tactical portfolios are changed throughout the years. Our target portfolios, they adjust once a month or when needed. So those are the things that we have to look at from there. Our individual stock portfolios, some of them are annual, some of them are quarterly. So it's just the idea of where you would like to be. And that's what I love about it. It's not a big deal for us to switch from one model to the other. I do have to consider taxes if it's in a non-qualified account, but an IRA account, it's just not that overly important. Well, Ginger and David were in the office, and they've got those same concerns that a lot of people have. Market corrections. We're getting ready to retire. We don't want to experience another 2000 or a 2008. And I could say if you're in that same situation, what do we look at? If we go to the insurance side of it, the fixed indexed annuity cannot go down due to market volatility. So if you were in that type of a portfolio, a negative market, you can't get less than a zero when you're talking about market volatility. So we've got it on two different sides. Can I protect it on the insurance side and participate in the markets when it does go up? I think that's very, very important. So I got the question, what are you doing to protect the gains that you've had over the last couple of years? Do you have a plan? Call now, ask for our risk-reward analysis. Give us the opportunity to look at your portfolio to help protect when markets go down.
Yeah, you need that protection. You need that opportunity for growth as well. This risk-reward analysis gives you a great opportunity to lay that full plan out. Again, it's going to be complimentary to our radio listeners today. That phone number, 636-230-8824, 636-230-8824. How much can you spend each month when you begin retirement so that you don't run out of money? Very popular question. And Christine Venz at Morningstar says they took everything into account and came up with this percentage pool for 2026.
We came out with 3.9% as a safe starting withdrawal for people who have an approximately 30-year time horizon. But my hope is that people don't just take that 3.9 or 4% and run with it, because in many scenarios, that will lead to significant underspending and really depriving themselves of a better quality of life that they could otherwise have.
Okay, so what do you think about this, Steve? Do you agree or disagree?
I look at that's one of the ways. I look at it and say, I think income and spending are the two most important things. We need an income plan. How are you going to replace that paycheck that you get in retirement? We can do what Christine said. The 4% rule. It's a rule that's been around for a long time. I like to add a year or two, maybe 3 in there to cover those time frames so that the 4%, we can build a bond portfolio, or we can look at it from the opposite side of it, get out of the investment world, go to the insurance. A fixed indexed annuity with an income rider, once I turn that income on, it's going to pay me that income for the rest of my life. If I decide to cover my wife also, it's a joint life. So those are the things that we have to look at. And income planning, I think, is very, very important. I get too many people that come into the office and say, my advisor says he doesn't really have an income plan. They're just going to make money and not take it when they can. I said, that's not an income plan to me. Call now. Ask about an income plan. Allow myself and my team to assist you on how you're going to replace your paycheck in retirement.
Again, it all happens with you right now. Calling for this income plan, it is 636-230-8824, 636-230-8824. That website, yourmoneymattersstl.com. This could make or break our friendship. Are you ready?
I am ready. Let's lock and load on this thing.
All right, this is a big one here. Are you a fan of Oreo cookies? And do you know about the double stuff?
Yes.
Yes, all around.
Yes, all the way around.
Are you a double stuff guy or just like the regular kind?
Regular's fine for me, but you have to break it in two. And if you're going to take it all off of one side, it doesn't matter whether it's one or two. You're going to get it all in one swoop anyway. If you really know how to eat an Oreo cookie.
That's right. Yeah, there's a whole process to it. You have to master that.
Now, I got a question.
Uh-huh.
Do you dip or do you not dip in milk?
Kind of depends what kind of mood I'm in, but I do like to dip.
If you have milk, you don't break it apart. If you don't have milk, you have to break it apart.
That's right. We're on the same page.
Oreo cookies.
That's it. So what are your rules? If you have an interesting way of eating an Oreo, I want to know. I want to hear. Give us a call. Let us know. Well, here's the deal. The name that you always hear, double stuff, obviously it makes you think that you're getting twice the amount of filling, right? But years ago, a math class at a New York high school actually put it to the test, and they found that double stuffed Oreos fell 7% short of the actual double of the size. So the label created expectations, right? Even when you buy it, it's probably a couple cents more, and you're thinking, yes, I'm getting all my money's worth here. But in reality, it was different. It got me thinking about retirement and your retirement money and taxes. I mean, sometimes people go into that conversation with you and they expect one thing and they're getting another when it comes to the taxes.
Yeah, it's one of those conventional financial wisdom, those things that we heard so often that we just assumed they were going to be true. You're going to be in a lower tax bracket in retirement. And that was kind of the idea around the 401k back in the 70s when it was brought into play, that we're going to give you a tax deduction for it now. It can grow tax deferred, and when you retire, you'll be in a lower tax bracket. Well, when that 401k was designed, the highest tax rates was 70-some%. So there was a pretty good chance. It was designed for wealthy business executives. But when I do almost all of my presentations, I ask that very simple question. Anybody in the room here that you're going to be in a lower tax bracket in retirement when you started saving? Everybody raises their hand. And then I ask the same question. How many of you actually are in a lower tax bracket? Everybody brings their hands down because there's very few people that aren't. And that's where they start to look at it. And people don't realize the, quote, talking about Oreo cookies, the bite the taxes is going to take out of your 401k. People don't realize if you're in the 22% tax bracket and you have 6% for the state of Missouri, you're looking at 28% tax. To get $1 that you can actually spend, you have to take $1.39 out of IRA or 401k account if you're going to pay the taxes up front. You can pay them all later, but be careful of penalties when those things happen. And that's where people start to look at it. Steve, I'm in a lower tax bracket right now. I said, have you thought about the facts that Social Security isn't always tax-free depending on how much money you make? What about RMDs? Have you thought about those RMDs? What about when you lose a loved one? Those single brackets get up into those higher rates much, much quicker. So we look at it. A lot of people didn't think about taxes. Taxes will not disappear when you get into retirement. Looking at it in a couple different ways. When I look at taxes, I look at it for the point of saying, let's look at it in a different view. Most people only look at taxes one way. How much can I save this year? I say, let's look at the big picture. What's it going to cost me over a lifetime? because I might lower mine as much as I possibly can, throw all that money into the IRAs and 401ks, and then pass a tax time bomb onto my children when myself and my wife pass away. And that's the thing that we have to look at. What's the total dollars that's going to happen? If you have an extra large 401k and IRA, the average amount's only about $189,000. So if you got between $250 and $500, you're going to have an extra large. What about a double X? 500 to about 1.5. Double X, 1.7 or above. Triple X. Those are the things that you start to look at that you are probably going to pass a tax time bomb onto your children. So I believe that by reducing or eliminating taxes, it's the best thing that you can do for your retirement. Give us a call. Allow us to do that tax analysis so we can sit down and figure out, may it make sense for you to pay some taxes now so that your children don't have to pay so much in the future. Give us a call. Ask for that tax analysis.
And again, this is a really great opportunity for you to look at the different tax options to be tax efficient as well, not passing on that tax time bomb. You sit down with Steve or a member of the team for this tax analysis, 636-230-8824. That's 636-230-8824. So what happens with that 401k when people retire? Well, according to a recent study by Vanguard, within 5 years, half of those folks roll over the money into their own IRA. Another third cash them out completely, and 17% just stay the plan. Steve, what are some ups and downs of keeping your money with the current 401k provider versus, somewhere else?
In the past, it was you have to move the money out of your 401k. That's not a true statement. You have four options. One, you can leave it right where it's at. Could be advantageous in some cases. The large employer, the cost could be a lot lower. If they have a very good distribution plan, some allow you to take it a little bit more often. Some you can't take the money very often. You have to do it like in 1, 2, 3, 4 distributions in a year. That can be very difficult. With a 401k, you're also required to have 20% withheld for federal taxes. So those are some of the negatives of the 401k. You can move it to a new employer if you're still going to be working, or move it to an IRA account. All three of those options, when done properly, are not taxable events. I think that's very important. Had a guy that had 7 401ks. I said, you need to put these in an IRA. And he goes, I don't want to pay the taxes on it all. A transfer from your 401k to an IRA is not a taxable event. In the IRAs, I look at it, we usually have a lot more investment options. We could look at it if income is important to us. We could try to build an income plan for you. So there are a lot of different things that you can do once it's out. It's usually a very simple call. Myself, somebody on my staff would get together with you and the 401k provider, ask what their specifics are. You have to be 59 and a half before that can happen, or if you separated employment before 59 and a half, you can do it. So if you're 59 and a half or greater and you have a 401k, give us a call. Let's do an analysis around your 401k to see if it might make sense for you to roll it out of the 401k into an IRA to increase your investment options.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group LLC.
This radio show is intended for information purposes only.